Hi, everyone. Welcome to the Policy Exchanges podcast. It's a big day today. The Chancellor has just outlined his autumn statement. And to discuss kind of these big fiscal and economic announcements, I'm joined by Ruth Kelly, former Secretary of State for Transport and former Secretary of State for Local Government and former employee at the Bank of England, and our Senior Fellow in Economics. And I'm also joined by our other Senior Fellow in Economics, Gerard Lyons, leading economist and former advisor to Boris Johnson. Just to start off, I think we'll start with the basics, I suppose. What did you both make of the fiscal statement today? I'll start with you, Ruth.
Yeah, well, I thought it was quite a well-judged statement in the sense that the Chancellor clearly had to calm the markets who had been completely spooked by the mini budget and tried to do it in such a way as to give himself maximum scope to support the economy over what are going to be incredibly difficult years ahead, whilst protecting the vulnerable as much as possible. So I think he just about pulled off that combination of establishing himself as credible without overkill and continuing to spend sensibly on public services over the next couple of years at a time when the economy really needs that support and capital investment, but beginning the process of fiscal consolidation by increasing taxes. All the really difficult decisions on spending were postponed until after the next election. And I'm sure that people who are on benefits and pensioners will have been relieved to see that the value of their pensions and benefits have been protected by the inflationary increases that have been promised.
Thank you. And what about you, Gerard? Do you agree with that assessment?
Yes, I do. It was a well-presented and finally, and shall we say, well-judged budget. If anything, it confirmed the incredibly difficult situation the UK economy finds itself in. Has to be said, it's not just peculiar to the UK. Much of Western Europe is in the same situation. Nonetheless, the stark message was clear. Even after today's measures, we're going to see a recession. The economy hit hard next year. Incomes are set to fall considerably. And even by the end of the forecast period, we're still going to see the economy in a difficult position compared to where it was before the COVID pandemic. Expectation management was very clear in recent weeks, so we were led to expect an incredibly tough budget. Thankfully, it didn't prove as bad as the expectations had led us to believe. And as Ruth has touched on, some of the measures, indeed many of the measures in terms of the squeeze on spending, are backloaded, coming later in the forecast horizon. In fact, over the next fiscal year, today's measures will provide, albeit in small amount, they will provide a net boost to the economy, with the changes in spending exceeding the changes in tax. But if ever one needed a budget to raise the question, what do we need to do to raise future growth? This surely has to be it. After today, we have a tax take that's even higher. We have a large amount of spending, but departmental spendings in many areas have been squeezed. Even after an increase in education spending announced today, one has to say many people would rightly question whether we're spending enough on education. So we have a difficult backdrop, and the root cause of the problem is that since 2008, the economy has grown at a very sluggish pace. We've become a low growth, low productivity, low wage economy. And then, as the Chancellor highlighted today, in the last couple of years, we've been hit by two shocks, the COVID pandemic and the war in Ukraine, that have made us poorer. So against that backdrop, he tried to do his best, but one has to say we are still in a very difficult situation.
Thank you. I think that both those answers really set the scene very nicely. On the question of growth, I'm going to come back to that, but I want to pick you up on something, Gerard, because you've written quite extensively about this for Policy Exchange before, and you've been quite an advocate for a different set of fiscal rules, certainly than the ones that had been implemented when Rishi Sunak was Chancellor. Today, the new Chancellor, Jeremy Hunt, came out with two new fiscal rules. One requiring public sector net debt to be falling as a percentage of GDP on the 5-year rolling period, and secondly, public sector net borrowing to be public sector net borrowing to be below 3% of GDP by the fifth year of the forecast. And I guess my question is, are these the right fiscal rules for the current time? And unlike the previous rules, which made a distinction between current and capital spending, the public sector net borrowing requirement to be below 3% of GDP doesn't make a distinction between current and capital spending. And I was wondering what you thought about both the rules in the round and also that particular mixing that's just occurred.
Well, let's take the mixing first, because the Chancellor went out of his way to highlight the fact that he was protecting capital spending or public capital spending in the next couple of years. So that was an important factor, given that in recent weeks concerns have been raised, shall we say, amongst economists and the general debate about the fact that capital investment might well be squeezed. So he went out of his way to highlight that he was protecting that in the next couple of years. And indeed, a number of infrastructure projects were highlighted. But coming back to the fiscal rules, I think the question is really, why did he feel the need to outline two new fiscal rules? And that comes back to the whole focus for the Chancellor, which was about stability, keeping the markets on side, which was something his predecessor, Kwasi Kwarteng, clearly did not do in that ill-fated mini-budget. And we have to remember that fiscal rules were introduced by Gordon Brown back in 1997, when he felt there was the need then to show the markets that he was fiscally credible and could be trusted. And those rules remained in place until the 2008 global financial crisis. But since then, we've had a whole plethora of rules. Normally, at the first time in trouble, they're ditched. I tend to think the only real rule that the market focuses on is reducing debt to GDP and having markers along the way. So in that respect, that is still being kept. But in terms of adding other fiscal rules, I tend to think maybe politically more is made of them than the financial markets make of them.
That's really interesting. Ruth, do you have anything to add to that?
Yes.
You were in government when Brown was Chancellor and when those fiscal rules
Yes.
first came in.
And sort of the goal of the Chancellor is to do as little as possible to reassure the markets, but as much as they need, while giving themselves the maximum latitude to take the decisions they think are right to support economic growth in the economy. And I think in this autumn statement, that's exactly what the Chancellor tried to do. So actually, as Gerard has said, there's a slight boost to the economy over the next year from fiscal policy rather than consolidation. So these rules need to be seen in that context. So what did he do to try and reassure the markets, apart from sounding very confident at the dispatch box and sort of giving an impression of being a very sensible steward of the economy? Well, he right at the beginning of the statement said the Bank of England mandate is going to be untouched. He published the OBR forecasts and referenced them throughout the statement, and he introduced some fiscal rules. Now, seen together, they're sort of de minimis what the market expects, and he seems to have sort of pulls that off in that the market reaction was fairly neutral. So I wouldn't read too much into them, really. The fiscal rules start to bite in 5 years' time. We'll know there'll have been a general election between now and then, and they're designed in such a way, the mix of current and capital spending on the 3%, designed in such a way to give him maximum scope to sort of use discretion as far as possible on the handling of the economy. So I think I sort of agree with Gerard here. It's a theoretical debate as to whether these are the right rules or not. These were the minimum required to settle the markets and to make them, believe that this is a fairly sensible government. In my view, a lot of handling the markets is about having a sensible economic narrative that people can buy into, and they believe you're not going to, throw the checkbook out of the window or, all sorts of fancy things that are just unfundable, incredible in the medium and long term.
That's really, really a helpful answer, and it's good to. It's I think important to point out that the fiscal rules are almost there as, in some sense, a political and not just an economic tool. Now, I want to pick up on this because obviously the OBR was heavily cited today, and the OBR is perhaps the key institution when it comes to judging whether or not the fiscal rules will be met. And I want to pick up on the fact that the previous administration, Sunak and Kwarteng, focused very much on supply side reform. And the current government has, at least in this statement, has at least kept some of that language. It's obviously been de-emphasized, but there were still some measures related to supply side reform. But something I saw in analysis of, a very quick analysis of the OBR's forecast today, is about the only sort of supply side measure or change that was at all factored into the OBR's forecast was the presumption that immigration would rise to about 200,000 net per year. And I suppose my question here is, we know that the supply side reform, changes to planning regulation, for example, are likely to have some kind of growth impact, but they're very hard to model. And I suppose my question to both of you is when it comes to growth, how hard is it politically to promise politically unappetizing reforms that in the short term that may generate long-term growth, but that long-term growth is very hard to forecast and might not factor into broader fiscal decisions in the short term to make them politically appetizing. I was just wondering if either of you could pick up on this and sort of give your thoughts on how, in the future, how government could try to be more ambitious with a growth agenda. Or maybe I'll start with you, Gerard. Sorry.
Okay, well, the Chancellor did in the third part of his budget today talk about some of these issues. He talked about energy, he talked about innovation, and then he talked about infrastructure. But in terms of your question, how you factor these into the forecast seemed to be part of your question. Now, the OBR would say that they were, or maybe I would imagine their defense might be, they were pressurized, I think it was under Chancellor Osborne, to factor in a higher growth premium attached to supply side changes. Admittedly, the supply side changes were pretty limited then, and they might argue they basically were forced to factor in something that failed to deliver. So the tendency now tends to be, let's wait to see the supply side measures feeding through before we factor them into having delivered future growth. Let's see it before we believe it. And I think that is disappointing because it's not the right way to be, because you're right, supply side measures can be positive for growth, but they do take some time to feed through. And if we're not factoring in, then they might constrain some of the public spending and also influence some of the tax plans now. But there's no doubt that if you're to have, in my view, a sensible, credible, meaningful pro-growth strategy, then it needs to have three arrows to it. One is monetary and financial stability, that in turn keeps inflation down and directs lending to the economy. Second arrow is fiscal credibility. But the third arrow has to be the whole supply side agenda. And maybe we saw we did see some of that today, but maybe we'll see more of that today. And yes, I do think this dynamic aspect needs to be factored more into some of the growth projections that accompany these budget documents.
That's really, really helpful. Ruth, do you have anything to add there?
Yeah, I mean, I can totally understand the OBR not wanting to forecast them in and build them into their models at the moment, given past performance on these really, really difficult issues, actually. What I would say is that the way supply side reform is being talked about, and we know it's necessary for long run growth, the trend rate of growth to increase, is quite different under Sunak and Hunt compared to the previous Prime Minister and Chancellor, who put a lot more emphasis on tax and lower tax rates in order to drive growth, rather than now when the Chancellor, Jeremy Hunt, pointed back to Rishi Sunak's previous speech, the May's lecture, where he talked about the underlying drivers of productivity and so forth, and much more emphasis on innovation and R&D, on infrastructure investment and skills. And we saw some of that come through in today's autumn statement. We saw the spending on the education system. We saw Michael Barber being brought in to advise on skills. We saw reference to R&D spending being maintained. and an emphasis on innovation. So the desire is there clearly. How much impact they can have at all in the short run, I think, is unclear. These are long-term measures to raise the trend rate of growth. So I think the OBR is probably just being fairly sensible, not factoring them in. As you say, Connor, these are really politically quite controversial sometimes. So seeing is believing, I think, as to whether they can raise the trend rate of growth.
That's really helpful. I'll shift. We've spoken about the OPR. I'll shift now to the other independent institution that got quite a look in the statement. That's obviously the Bank of England. And I want to pick up in particular on something the Chancellor said, which is he wanted fiscal and monetary policy to move in lockstep. Ruth, you're a former employee of the Bank of England. What does a Chancellor mean when he says that? And is it a good thing? Is it a bad thing? Is it contextual? What were your thoughts when you heard that?
Well, I think it would be worrying if the Treasury and the Bank of England didn't talk to each other on a very regular basis and understand how each was operating and try and accommodate the way that the other institutions is thinking at that time. Very important, for instance, in the bank's next forecast of interest rates and move on interest rates, that they understand the fiscal profile that's being adopted by the government, and arguably, to go back to Gerard's point, whether there are opportunities to increase the trend rate of growth and so forth, and that interest rates don't therefore go higher than they need to if the Treasury's understanding is fully understood. So I think moving in lockstep means a deeper and better exchange of views rather than any joint decisions on fiscal and monetary policy, as it were. I don't think the bank is being asked, as it were, to input into fiscal policy decisions or vice versa, just that the liaise in a sensible way of managing the economy.
Thank you. That's really interesting. I find it really striking that sort of there seemed to be a period there where they almost didn't speak to each other, and now the language is all that actually no. Without saying it directly, that it was really clear that the Chancellor wanted to indicate that he was speaking and with and engaging more with the Governor and the MPC. That really striking change.
There are reasons for that, I would say. One could link those to the previous Chancellor's period. One was about the markets questioning this whole issue about institutions. The previous Chancellor and the previous Prime Minister had raised issues not just about the OBR, as we saw, the Treasury and also the bank. So I think it was partly that. Also, the timing of the mini budget, the markets were in a very febrile state. And that was as much due to the fact the markets then were very worried about inflation and hence felt that at the time of the mini budget, fiscal and monetary policy were not moving in the same direction. So I think part of the Chancellor's comments today reflected those issues. That being said, I would say, and many in the markets I think would agree, that at the beginning of last year, this relationship between the bank and the Treasury moved out of line in the sense that then the bank was seen as being very much playing to the Treasury's tune. It engaged in quantitative easing, so much so it now owns close to a third of the national debt. As interest rates and yields go up, that inevitably means a huge cost to the taxpayer, which as the Treasury indemnifies the bank's holdings. And at the beginning of last year, it was widely felt in the markets that the government could have borrowed relatively cheaply and probably quite easily in the markets, given the global appetite for government debt at that time, when inflationary pressures and interest rates were at that time very low. So I think whilst it's good and important for monetary and fiscal policy to be aligned, at the beginning of last year, I think the Bank of England was far from independent and very much did as the Treasury called for. But today, I think it was very much aimed at the Chancellor reaffirming to the markets that, look, we're going to keep inflation in check. And indeed, one might argue politically, if one went off in a tangent on this, that maybe from Conservative Party perspective, in the last few weeks, the government has been seen as owning the interest rate hike and maybe politically they wanted to do as much today on fiscal policy to minimise the possibility of interest rates going too high, because even though monetary policy is in the remit of the Bank of England, in recent weeks we've seen any mention of interest rates going up being associated with the government. So I think there's that political angle that came into play as well, but probably best to leave it to the politicians to delve into that.
So thank you so much, Gerard, for picking up on that, because that was really going to be my next question, which is that it seems to me that one of the things that unfortunately the mini budget did was it consolidated in the mind of a lot of voters in the UK, a lot of people in the UK, the idea that the government was in some ways responsible for where the interest rate was set. Obviously, perhaps not directly, but that fiscal policy clearly had a role to play in where interest rates and where the Bank of England ended up. And I suppose my question is there a danger in the Treasury deciding on where it would like monetary policy to be and designing a fiscal policy in part to accommodate that desire? I'm thinking back, this is many years ago now, but I recall when George Osborne used to say that one of the aims of our fiscal policy is to ensure that monetary policy can be kept quite low. I think this was around 2012, 2013. And I suppose, is there ever a danger where the Treasury becomes led by monetary concerns unduly?
So look, I think when both economic institutions think broadly similarly about macroeconomic policy, it tends to work quite well. There tends to be a sort of natural synergy between fiscal and monetary policy. When you have the sort of Truss Kwarteng mini budget that takes an unorthodox approach to macroeconomic policy, which the bank, using its own economic models and so forth, does on its hands, because it's then got to use monetary policy to offset the inflationary impact, as it saw it, of government policy. And that's when you get, as it were, the two acting in completely different directions and a dysfunctionality at the heart of economic policy. So I think it's more about trying to avoid that situation. I don't think that situation is sustainable. Well, we saw it wasn't sustainable. The whole thing blew up. We almost had a financial crisis on our hands as well as dysfunctionality in economic policy. So with institutions, independence, because we have a received wisdom and relatively common understanding about how the economy works. If one party breaks away from that consensus very significantly, then the economy is going to run into problems, and they're going to be at loggerheads with each other, the two institutions.
Do you have anything to add to that, Gerard?
No, I agree with that.
Yeah, perfect. I think we're going to wrap up soon, but I suppose my next question is: what measures were you happiest to see in the fiscal statement today? And are there any measures in particular that you think are particularly important that the government ought to highlight, either from a growth perspective or from a public services perspective? Were there any measures that you were particularly happy and that you welcome?
I very much welcome the vulnerable being protected throughout the fiscal consolidation, well, as far as we can see into the short to medium term in any respect. And I welcome very much the emphasis, for the first time in a long time actually, on public service reform. I hope we are seeing the genesis of a new approach to the public sector, bringing in Patricia Hewitt as an advisor on health service efficiency, bringing in Michael Barber on skills and so forth, to generate new ideas and new approaches to what are incredibly difficult problems, which the government just has to be able to deal with if it's going to protect the quality of public services in the medium term.
Thank you.
Yeah, I agree with Ruth about the help to the vulnerable and about the focus on public sector reform. In addition, I like the fact that the energy help is to be more targeted than previously talked about. Also, I like the fact that he avoided going down the Osborne route of austerity. It didn't work the first time. But coming back to the supply side agenda, I tend to think the supply side agenda, in addition to the areas the Chancellor talked on, such as innovation and infrastructure, it also includes incentives and investment. And on incentives, one of the issues arising from today is that the tax take is very high. We've seen a whole host of stealth tax increases that will hit middle income, shall we say, people who are not on particularly high incomes, and that's an issue. And to conclude, maybe it's the investment picture. In the OBR forecasts, investment projections are very poor. Now, it has to be said, we've had decades of low investment in the UK. I think this is one of the key reasons why we have such a low trend rate of growth. And maybe the disappointing aspect is that the corporation tax increase has gone ahead. Economists correctly pointed out that when the corporation tax rate came down, it did not boost overall investment. But the one thing that we did see, and the OBR pointed this out a couple of years ago, when the corporation tax rate came down before, the tax base was widened. So the lower rate of corporation tax applied to a wider array of areas. So the tax take didn't change on it. So if we now see it going back up, as indeed has been endorsed today, then we're going to have that higher rate of corporation tax on the wider array of areas. And my concern is that that might hit many small, medium-sized firms who are still, one would say, the lifeblood of the economy, but incredibly vulnerable in the wake of the shocks we've had in recent years. So there were positives, but there are some areas that we should be concerned about. And indeed, as we head into a recession, let's hope it is as shallow and hopefully even shorter lived than the Chancellor was advocating.
Absolutely. Thank you. I'll pick Ruth up on the same. Was anything you thought was missing from the statement today?
On the corporation tax front, I would have expected to see more generous investment allowances, for example. It seems, it tends to be one or the other. There were neither in this budget that I saw. I would have liked to see investment zones were scrapped. They were replaced with university clusters. I don't yet know what that means, but we need some real, local growth initiatives if we are ultimately to see that trend rate of growth rise. So I hope there'll be more to come in this area in the months ahead.
Yeah, I join you. I was actually, from my part, I know that the government had been really keen on getting trailblazing deals in Manchester and West Midlands over the line, and I'm sorry that they didn't. But it's good to see at least that they are proceeding with some of those devolution local deals, even in maybe a slower pace than some of us had hoped. But in any case, thank you so very much for your time today. A really wide-ranging discussion. And I know many of our viewers will find it, and listeners, I suppose, will find it informative and enlightening. It's a very difficult year to come, very difficult few years to come. No doubt we'll be here again, but thank you so much for your time.